me start with sort of the observation that the world has been trying to pass some form of a carbon tax for close to 50 years. Obviously, it's not been very successful. So now, sort of in the last 5 years, you're seeing this immense pressure on the financial sector and regulators to do something, to basically keep global warming, as Ami kind of pointed out, somewhere to be between 1.5 to 2 degrees Celsius. And there's not a lot of room left. And sort of one of the widely discussed solutions in the financial industry are these sustainable investment mandates, where the idea is that wealth of households or wealth of institutions, institutional asset managers can only be invested in companies that meet net zero emissions targets by some date, 2030, 2050. And the amounts of money are quite sizable. And I think that the pledges are quite sincere. So for instance, one such initiative, this Net Zero Asset Managers Initiative, exactly outlines these mandates. It's got about 87 massive signatories, accounting for $37 trillion in assets under management. And that's just kind of name one initiative. And there's also now basically something called the Network for the Greening of the Financial System that basically encompasses banks, central banks, where the idea is exactly the same, that rather than going through equity markets, you might go through bond markets and impose exactly the same mandates. And so the way that this works in practice is that you're a firm, to qualify to be held by these pools of money, you need to contribute to sort of what we'll call decarbonization capital stock, N, right? And as opposed to sort of typically making investments in productive capital stock, K. So in practice, what this means is some flow mitigation spending that firms have to engage in a portfolio of decarbonization measures, like whether it's like planting of trees or regenerating forests, it could be some carbon sequestration, it could be bioenergy carbon capture, it could be air capture. And I think the important thing to note is that, so IPCC in their last sort of release said that almost all the kind of pathways now that one can envision in terms of meeting these targets involve basically accumulating a fairly significant amount of decarbonization capital between now and the next 10 to 20 years. And sort of the idea of these mandates is that it's going to send price signals for firms to decarbonize, right? The problem is there's not a carbon tax that's sending the signal. So you need some other signal in the system so that firms can do something, can have some incentive. And sort of profit, and we have to sort of take the view that firms are profit maximizing. So they have to be sort of indifferent between being sustainable or not, right? It's got to be sort of this voluntary action that these mandates are presumably going to send these price signals, and then there's going to be some equilibrium trade-offs that the firms are going to engage in so that they're indifferent. And the way it's going to work is these portfolio restrictions of these investors, which also implies some shorting restrictions. In equilibrium means that the sustainable firms are going to get a lower cost of capital, i.e. they're going to get a higher price, right? And that's going to basically offset and pay for their contributions to decarbonization. In other words, sustainable finance is a form of a capital tax that is kind of premised on being sustainable or not, okay? And I did not coordinate with the meet on this, but I like this slide because this is sort of, Microsoft is one of the firms that are very enthusiastically supporting such a solution, essentially, right? And what I like about it is it's fairly specific, right? There are numbers, there are some at least sort of projections and some technology or some accumulation of capital to indicate how this is going to get achieved. So since Amit talked about this, I'm not going to have to spend much time, except that the green is exactly sort of what we're talking about. And sort of to Amit's earlier thing about why Microsoft is doing this, one of the reasons I think is exactly the sustainable finance mandates, that there's a huge incentive for firms, exactly because if in fact these mandates of trillions of dollars are going to be enforced, that's going to move the needle a little bit. But it does raise a lot of difficult questions, right? So how effective will these mandates be compared to sort of what we might think as the planners first best? How much sustainable finance do you need? How many years do you need for this sort of transition and this accumulation of decarbonization capital stock? What happens in the interim to economic growth when you're building up all of these forests? What are the consequences for firms' cost of capital? And who ultimately is paying for all of this stuff, basically? Okay, and these are difficult questions. So what I'll talk about is to give some preliminary answers using kind of a growth model that's going to feature what we'll call kind of decarbonization, which is non-productive capital stock versus like a productive capital stock, what we typically work with. And this is based on a paper examining the welfare consequences of sustainable finance with Nung Wang and our moderator, and also Jin-Chang Yang. So the basic idea is the following. You start with a growth model, okay, that's sort of often used in terms of climate economics. And you're going to have sort of these extreme temperature events. Let's call it 2 degrees Celsius above a country's historical normal, right? And in years when you have lots of these extreme temperatures, that's going to have some destruction. You can kind of pick. You can like destroy its capital, or you could destroy kind of some productivity. But regardless, it's going to increase a lot of aggregate risk in the world. So think about firm emissions as roughly proportional to their productive capital stock. And so there's going to be from a planner perspective, there's a big willingness to pay for some decarbonization, but there's going to be externalities, the commons problem, as Steve pointed out. There's going to be some costly and gradual adjustment of both capital stocks, right? So it's not going to be, we can't build all these forests overnight. We can't plant all these forests overnight. There's going to be some adjustment costs. And sort of ultimately, if you kind of believe in the science, the ratio of decarbonization to productive capital stock, which we'll call little n, is going to sort of be the mainstay variable and helps mitigate the damages associated with emissions, right? And then firms are going to get qualified on these mandates based on their flow contributions to this stock. So, the model is not perfect. It's going to miss some important elements that are kind of climate economics, but I think kind of what it can do, though, is to answer more of these practical questions associated with sustainable finance. So the way we'll do it is we'll kind of calibrate the model using historical data on how excessive annual temperatures at the country level reduces GDP growth. Okay. Now, obviously, these 1.5 degree events, 2 degrees events are relatively rare in historical sample, but when they do happen, there's damage, and we're going to use that as kind of an input into calculating the costs and benefits of this decarbonization capital. We'll combine this with some parameters from kind of the long-run risk literature from asset pricing, essentially, that basically kind of gives a fairly high willingness to pay on the part of agents for reducing risk. And then we'll get some adjustment cost parameters from the literature. Now, obviously, we have much better estimates for physical capital K than we do for N, since we haven't built up a whole lot of decarbonization capital in our history. So there's going to be some uncertainty there. And then we'll pin down the costliness of accumulating this decarbonization by assuming that in the past, optimal mitigation was kind of negligible because things were not that bad, basically. And then we'll ask, well, now as the world gets kind of worse and worse, right? And I think this is the moment that we're in. There's obviously increased incentives to begin this accumulation. And so we can kind of then ask a bunch of standard, try to answer some of the difficult questions I alluded to.
Harrison, 2 more minutes.
Yeah, that's perfect. Thanks. So I think that's the setup. So, I mean, there's kind of a mixed bag. I think there's good news for mandates in the sense that, in our calculations, in the steady state, you need like 6.25% of this N star. So think about like $600 trillion of physical capital. That means you need about $34.5 trillion of this decarbonization capital stock. That's quite a lot of money because each year that means the world has to spend something like $3.86 trillion annually, right, on this, right? And that's a big price tag, okay, to kind of Steve's point. There's mixed news for growth. I mean, the European Commission, I think, has these projections saying how the transition to net zero is going to be super rosy because, I think there's an assumption that you can do all of this with just renewables, right? But I think kind of if you take the decarbonization capital stock view that the IPCC has, this is not very productive capital. So there's going to be basically some economic trade-offs in the short run. Although, of course, the benefits in the long run could be quite substantial. And then for institutional investors, it's pretty costly too. There's a lot of rosy projections from BlackRock and others on sort of all of these benefits without articulating what the numbers are. So, our model gives you some numbers. We generously think we can get 20% of global wealth to be indexed to sustainable firms to send these market signals. The representative investor has to give up basically about 3.25% of expected returns on this 20% of wealth, right? And this qualifying standards, are going to tend to rise over time, because basically right now, of course, nobody's doing anything, so you don't have to compensate anybody. So calling yourself sustainable is pretty cheap because nobody's doing anything. But if we're serious to get to like $34 trillion worth of capital stock, people have to start spending some money, right? And then that has to get paid somewhere in the system. So the investor, the representative investor, has got to basically give up 3.25% of yield to fund this. And so, of course, there's a lot of caveats that I think Lars is going to talk about. There's a lot of parameters that we have to kind of deal with, et cetera. But these are sort of very preliminary and give you the gist, at least, of, I think, some preliminary answers to these difficult questions. Thanks.
Thank you, Harrison. The discussant is Professor Lars Peter Hansen from University of Chicago. Lars is a distinguished David Rockefeller Professor of Economics and Statistics at Chicago. He's a Nobel laureate and also a member of the academic committee of Luohan Academy. Lars, please take it away. Thank you.
Sure. Thank you very much for this opportunity to talk about this very important subject. Reading Harrison's slides led me to go and read some papers that he's been writing recently with various co-authors that I found very interesting and fascinating. So it was it's obviously a very important topic. To address climate change, we think of this as an externality. Therefore, we have to think about, from economist perspective, how do we restructure incentives? As Harrison talked about, things like carbon taxation has been somewhat frustrating in terms of its ability to be implemented. Cap and trade policies have been certainly slow to materialize. My own work has been connected to things like uncertainty contributions to hypothetical social cost of carbon, which can be substantial, but I agree that that's been a policy that's been very slow to be adopted. There's been much recent discussion about central bank policies, about what central banks can do. I worry at times that we might be asking central banks to be doing, hoping for them to be doing too much because they're somewhat distant from the political arena. We could have a very interesting conversations about that. Certainly they play roles in financial stability. Well, let me go to the very interesting policy approach that is discussed by in this paper, in this talk, as well as by the three authors for the quantitative work that followed. So let me say at the outset that I really appreciate the fact that the authors are writing down this kind of fully specified dynamic model. It's stochastic. It's got some nice innovative aspects to it. It builds extensively on some earlier work of Ming Wang's with multiple capital stocks, and that work was done with Janice Heberle. She said it builds on some stuff that Ming's done with pinned icon uncertainty, but this paper really pushes it into a very important policy challenge, and I appreciate that aspect of it. It's an intertemporal technology here that underlies their calculations. It's a productive that evolves stochastically. There's this external decarbonized capital that also evolves stochastically and with a drawdown to emissions. We're going to take output, we're going to split it between consumption, investment, productive capital, and investment in decarbonized capital. This will be a jump process that then governs the stochastic degradation of the capital stock. So the basic resource allocation problem is what fraction of output should be allocated to mitigation investment and how should this be achieved? So this is not about what firms do to look after their own long-term interests, as we heard you discuss in the context of Microsoft. This is about this externality out there, the part that firms do not internalize. And then how do we get resources into that? How should we proceed? And so that there could be a fictitious planner that figures out how to do this, taking into account the externality, and then we design policies, and the authors consider such a policy in their analysis. So this type of modeling, at the end of the day, this is a quantitative calculation, and a very important one, potentially important one. If we're going to engage in kind of quantitative policy analysis, how do we proceed? Now, to proceed, to go forward, modeling this area, you either turn things into an enormous black box, which is, or you have to make a bunch of modeling simplifications. This is true in my own work. I'm and showing this paper here. I think it's important we really understand those simplifications, though, and what role they play. So here, there's no explicit climate dynamics. There's no temperature anomaly, carbon in the atmosphere, not state variables. We're somewhat distant for talking about things like 1.5 or 2 degrees Celsius targets or thresholds. This makes it difficult to relate to climate science evidence, which I'll talk about in just a minute. And it makes it difficult to talk about temperature anomalies, thresholds. Maybe those are overplayed. It could be that could be easily argued as well. Now the damage, there's disaster damage probabilities that are specified here that are going to depend on these two different types of carbon capital stocks. There's this unproductive decarbonized capital, unproductive to the firm, productive socially, and there's this productive capital. And these disasters will depend on the ratios of these. And then there's going to be an environmental externality that triggers damages in the capital stock that's related to the ratio. Now, the model takes things like emissions as some exogenously specified entity. In the paper, it's homogeneous of degree 1 in the two capital stocks. This means that the externalities, though, the damages are homogeneous in degree 0 and not degree 1. So this means you shift the overall scale of the economy. That's not affecting the sectionality here. And to me, that's a rather big tension, because there's a lot of climate evidence. It's all about how we go from emissions to temperature change to potential economic damages. Okay. And so this is where I think there's a bit of a modeling tension in this paper, one that at least I struggle with in terms of using for this particular problem. So let me go forward a little bit and talk a little bit about the type of evidence that one might want to think about integrating. This is some work we've tried to integrate in our own work on uncertainty. Carbon models and temperature models and carbon cycle models are highly complex. You couldn't possibly put them inside an economic dynamic model and proceed. You have to use simplifications. Climate scientists themselves have devised some very interesting ways to do model comparisons across these different modeling groups. They do things like they run through scenarios. They also do pulse experiments. So what I'm showing here are the outcome of pulse experiments. What you do is you put an emissions pulse in the atmosphere, and then you look across, in this case, I think it's 144 different model combinations of temperature models. And these are the responses that come out of it. There's appropriate adjustment of units here, which you need to be making in order to go 5 years. But there's a common pattern on these models that if you emit carbon in the atmosphere, you get a peak effect in about a decade, and then it flattens out. Right? Now, and what I'm showing you here is the mean effect across these 144 model combinations, plus the 75th and 25th percentile, and then there's the upper and lower envelopes. This is the type of uncertainty that comes out of the model, out of the climate type of models that would seem to want to integrate into thinking about economic and environmental damages. Notice these depend on temperature, I notice these depend on emissions, and emissions here, recall, were homogeneous at degree 1, not 0. So here's this hypothetical damage function. Suppose that we've got damages that start getting triggered after 2 degrees. And then there may be some range over different damage responses, all the way from some economists argue for very modest responses, some argue for much steeper ones. As you proceeded over the last several years, the base rate of the threshold would be 2, would be 1.5. So it's uncertainty about where that threshold is going to be triggered, and then the curvature that follows. This is just an example of the type of damage function uncertainty which one could encounter. Here we deal with this problem, probabilistically. But these type of inputs are not really possible to map directly into the framework of the current model, in part because of the modeling assumptions, and so I worry a little bit that in terms of translating the results. Now the paper features in a very interesting way this decarbonization capital and carbon capture, and I think these are very important things to be thinking about. I wasn't quite sure how to interpret the quantitative magnitude inside the model, and or kind of what this kind of carbon neutrality or net zero type goals might connect to it. Now the model itself has a planner's problem, so maybe we shouldn't care about this. As long as we get that planner's problem correct, we could compare it to what the optimal to what comes out of that planner's problem, which I gather is the spirit of this analysis. This thing features mitigation mandates, which is certainly lots of interest in. I sometimes wonder, though, how do we make these enforcements meaningful? We can kind of announce these mandates, but who's going to enforce them? How do we know that we're going to be making productive investments in decarbonization? Are these going to be mitigation resources that just get handed over to some type of policymaker, or are these to be done by the firms themselves? And if they're to be done by the firms themselves, how do we know they're really accomplishing what we want them to do without some really serious monitoring? So I'm a little bit concerned about that part of it, about this policy.
Lars, yeah, so 1 to 2 minutes, please. Yes. Thank you, sorry.
One of those interesting parts of this paper, I think, the one that could probably even use even more emphasis is they build this competitive equilibrium under which there are these two types of firms that are sustained. Inside this model, investors do not have a direct utility increase for sustainable portfolios. The other papers put it in there exogenously, and it seems somewhat mechanical. In this paper, investors care about, consumers and investors care about their own future consumption. Firms have to actually sacrifice output by agreeing to be sustainable. This isn't about their long-term benefit, they're actually sacrificing output. Now, this leads to heterogeneous exposures that sustain these expected return differentials. The question is, how would this apply in an extreme form of a deterministic model where rates of return would have to be the same? I think this is a very interesting part of the analysis, how this type of competitive equilibrium gets sustained, ones under which this policy then can have some potency. So, I mean, my advice to the authors is I think this is actually the most interesting part of their paper, more than some of the complete sets of quantifications. So in concluding remarks, I like the models, these two capital models. They're very important for policy analysis. I think the capitals, what I'd be thinking about, though, include things like green capital, green technologies. It'd be nice to put on the table issues about investment. Is it prudent to have socially productive investment in new green technologies? Which is so it's another type of policy which I think would be important to study. That would also entail these two capitals. For me, I think it's important to include multiple sources of uncertainty, including some coming from the economic damages, from environmental damages, and from these temperature and carbon dynamics. I think it's very valuable to these quantitative exercises, but as a collective group of economists, it would be nice if we could figure out ways to do more serious multiple comparisons. The models that I've written down have their own set of shortcomings. It's very easy to pick on them and isolate where they fall short and what questions they can address. It's really valuable to be looking across models. And if each researcher is building their own model, where's the research that's really doing the meaningful cross-model comparisons that I think is really important for policy analysis. Finally, I worry about the meaningful implementation of these mitigation mandates, how credibly they can be enforced. I think the author, I think Harrison talked about a very important problem, and I think he's put on the table a very interesting policy. Thank you very much.